In this episode of the MSA Rental Market Update, we are looking at the student town of Columbus, Ohio. So we'll be looking at the Columbus rental market for multifamily properties. And it's not just a student town because of Ohio State University. It is also the capital of Ohio. So 3 straight markets in a row this week: Tallahassee, Montgomery, Alabama, and Columbus, Ohio, all government communities, 2 out of the 3 being student communities. Now, there are universities in Montgomery, but they are not large universities like Florida State or Ohio State. Okay, so let's take a look at where this is located. So Columbus, Ohio is kind of in the south, I wouldn't call it western, more southern part of Ohio. You can see Cincinnati is down here, which is right along the Kentucky and Indiana state lines. We've got Pittsburgh over here, Akron over here. If I scroll out just a little bit, you'll see Cleveland at the top over here. Chicago's over here, and here is the U.S.-Canada border. So you can kind of see where Kentucky comes up with this dotted line all the way up. So Cincinnati sits in that very southwestern corner, where the Columbus MSA is just to the northeast of that. All right, that's where it's located. Let's look at our filters. As always, we will be excluding corporate, military, senior, and vacation, and only including market and market affordable. So we are only looking at conventional apartments. We're going to start looking at all 3 asset classes together, A, B, and C. We do not care about the Fs. CoStar really doesn't classify anything as an F, very few properties, so it wouldn't change the data set either way. If we go to location, we're looking at market, metro statistical area, Columbus, Ohio, keeping in line with our metro statistical area rental market updates. So all that said, let's go in and see what the analytics tell us. So here is our supply side snapshot. We can see there are 4,063 properties in the Columbus, Ohio metro statistical area, totaling 210,310 units. There are currently 7,771 units under construction and only 1,546 units rented in 2022, where 8,355 units rented in 2021. So that's more units. That is a net result. So 1,546 more units rented than went vacant in 2022, where 8,355 more units rented than went vacant in 2021, a decrease of 81.5%. And we can see that in the vacancy, where a year ago vacancy was 5.3% and now it's up to 6.7%. We are still showing a year-over-year rent growth of 5.3%, but we'll see what it looks like quarter over quarter. As usual, we do not look at the capital markets. We only look at the supply side rental market. And so if we scroll down, we can look at our long-term occupancy average at 93.07%, and the market is currently sitting at 93.31%. So pretty much right on that long-term occupancy line. And the fact that we have units under construction and way more to deliver, and a slowing in absorption and an increase in vacancy with some rent growth, tells me that we are sitting on the long-term occupancy average in between oversupply and recession, but on the top of the line, not on the bottom of the line. But it looks like it's starting to head that direction. Let's see if the data tells us that. So let's go look at data for class A, B, and C combined, and then we'll look at the A's individually, the B's individually, and the C's individually. So here is all asset classes together. We do not look at asking rent, which is why we don't go to apartments.com or Rent-A-Meter, because you will only get asking rents from there. Asking is what the ownership and management want. Effective rent is what they're actually collecting. So we are looking at effective rents. First quarter of 2022, it was at 1147, went up to 1186, very slightly down to 1185, and then down to 1181. So we've seen a fracture happen between the second and third quarter, albeit very small. So let's see if we can head over to our deliveries and absorption and see what that is telling us. So here are the deliveries. If we look, we got 729 delivered in the first quarter and 1273 absorbed. Good, strong absorption explains that rent increase from the first quarter to the second quarter. Then we delivered 1,980 and absorbed 1,865. So another good, strong showing in absorption. But then it starts to fracture, and we can see that in the rents. So we delivered another 1,308 units, brand new to the market vacant, and then an additional 414 went vacant in that same time frame. So a total of 1,722 units went vacant in the third quarter. Then another 842 units were delivered brand new vacant to the market, and another 389 units went vacant in addition to that. So we definitely are seeing a exodus in the third and fourth quarter from these rents. And we can see that in the occupancy. Occupancy was 94.8 going into first quarter 2022 and is down to 93.5, okay, which is right at that long-term occupancy average. So we can see that the tenants or residents at this point have basically said, we can't pay these rents anymore, so we're going to start doubling and tripling up, and that is what is occurring. So that's the overall asset class. Let's see which asset class is bringing it down or if it's shared across all three. So let's go take a look at our Class A market. So here is the Class A rent analytic. We have 124 properties totaling 26,075 units. We are looking at effective rent, and in the first quarter, we started at $1,492, went up to $1,546, and then the downtrend started down to $1,534, and then down to $1,523. So we've seen a fracture happen between second and third quarter of 2022. Let's see what deliveries and absorption tell us. So we had no deliveries. Actually, we've had very few deliveries in this market, which tells me most of the deliveries were in the Class B space. And NOIs, with the rents the way they are, NOIs are high enough that you can afford to build to a Class B status. So that doesn't surprise me. So we had no deliveries and 432 absorbed. Good, strong numbers. Then only 12 units absorbed, a little 12-unit apartment building, and delivered, and then 291 absorbed. Another good, strong showing. Then the fracture occurs. We had 748 delivered vacant to the market brand new and only 194 absorbed. That is not good at all. We like to see 80+% to stay stabilized. Then no deliveries and another 34 units went vacant in the fourth quarter. We can see that in the occupancy, where the occupancy ticked up in the second quarter and then started its downtrend from there. Okay, so that explains why the rents are declining. So demand and supply for the A market is reacting appropriately. So we can see that it's a very small trend in the Class A, albeit there's not that many Class A properties. We still only have 1,157 of the 7,000 plus under construction, still under construction for Class A, which again tells me this is a big Class B market. So let's see what the Class B data shows us. Here is our Class B rent analytic data. We have 634 properties totaling 84,921 units. We are looking at effective rent. In the first quarter, we were at $1,263, went up to $1,306 in the second, and then down we started to slide. $1,300 in the second quarter or in the third quarter, and then $1,287 in the fourth quarter. Fourth quarter's rents were actually lower than they were in the second quarter. So once again, because you see a 4.3% year-over-year growth, or in asking rents 4.8, which is what the broker is going to show you, you've got to look at the quarterly numbers. Do not rely on an annual trend when you get into this phase of the cycle. Knowing a recession is coming, you've got to look at quarter over quarter, where we start to see these fractures occur. You would have no idea, knowing that rents were declining, if you listened to a broker that told you there was 4.3% rent growth, and we expect to see that for the next 2, 3, 4, 5 years, which is what they're going to tell you because it's their job to sell the property. Trust me, I was a broker for 10 years. I know this already. Okay, so let's look at construction, deliveries, and absorption and see what that is telling us. So we had 240 deliver in the first quarter, 644, so almost 3 times the amount. So good, strong absorption. Then we had 1,665 deliver and only 1,321. Pretty close to that 80% mark, not too bad, which shows the rents reflecting accordingly. But then the fracture occurs. 559 delivered new to the market, vacant, and another 421 delivered absorbed negatively. So another 421 went vacant in addition to the 559. So almost 1,000 units went vacant in the third quarter. Then another 842 units went vacant and only 112 absorbed. So definitely had that fracture occur between the second and third quarter in the B class. And we can see that with the occupancy going from 94.9 to 92.7. So the occupancy is actually below the long-term occupancy average for the B class, where it was right on that long-term occupancy average for the A's. Let's take a look at the C's and see what the C's are telling us. It's kind of been a roller coaster lately, so I'm going to reserve my opinion until we look at it. So here is our Class C rent analytic data. We have 3,119 total properties, totaling 98,877 units. Looking at effective rent, we started at $921 in the first quarter, went up to $950 in the second, up to $957 in the third, and up to $965 in the fourth. Interesting. We have seen this pretty consistently around the country, so kind of 50-50 split lately, where we don't see a fracture in the Class C rents, a steady increase up. Albeit if you look at year over year, it is showing a 6.9% year over year. Okay, so what is this telling us? Well, if we look at the vacancy, we can look at the vacancy and see that it was stable between first and second quarter, then increased in the third quarter and increased in the fourth quarter. Now, keeping in mind this vacancy is low in the market, so I kind of don't blame the owners for pushing these rents higher because we have a pretty low vacancy considering where the long-term occupancy average is. So let's see what the absorption's telling us, because we should not have any deliveries. You are showing some deliveries here and some under construction, but this is erroneous data. You will never deliver a Class C project to the marketplace. These are probably in Class C neighborhoods, but they will be delivered as Bs. So if we look, we had 197 absorb in the first quarter and 254 in the second quarter, and then the exit started to occur at that point. So we have 187 more units went vacant in the third, and another 465 more units went vacant in the fourth. This trend should show an increase in vacancy, and it did. It shows a decrease in occupancy and should show a decrease in rents. But again, our occupancy is above that long-term occupancy average, albeit hitting right on it. So I think we're going to start to see, as this trend continues, of them doubling and tripling up, because there is economic indicators in Columbus that shows that we should have demand. But because of affordability, the residents are doubling and tripling up and becoming roommates with each other, or they're moving back in with parents, or families are moving in together, kind of like we saw in 08, 09, and 10. We're seeing it again in just about every single one of these markets we've looked at. So even though we do not have a rent decrease yet, that rent decrease is coming very, very soon, because as the occupancy continues to go down, that's driving the NOI down, which the owners are going to start to get nervous about, and so they will start lowering those rents to get those units filled up. So that is the Columbus, Ohio Metro Statistical Area rental market update. This confirms that it is between oversupply and recession, sitting right on that long-term occupancy average line, and has a little bit to go, maybe a quarter, maybe 2 quarters before it dips down into recession, but it is definitely heading that way. And I would say the number one cause is because of affordability. So stay tuned tomorrow for a market that a lot of people have been looking forward to. We will tackle the Nashville, Tennessee metro statistical area, and then we will finish the week on Friday with Houston, Texas. I will see you guys tomorrow.